Okay, a quick word about the many benefits of becoming a member of the Green Star Trading Patreon. Maybe give yourself a belated Christmas present, or maybe consider signing up at the start of the new year. Perfect time to do it. Anyway, a quick rundown of what you can expect. So if you sign up to our most popular tier, which is the tier 2 here for £10 a month, you get access to the public Discord, you get access to weekly live streams. There's dozens of channels on the Discord in which you can communicate with our members. You also get access to loads of exclusive content, all of the educational materials I pull out, and all of the exclusive weekly content I pull out, which doesn't go on YouTube, plus my Elliott Wave series, trading content, all sorts of stuff. That's for £10 a month. £15 a month bags you all of that same stuff, but it also gives you access to the proprietary stock rating system and dividend calendar that I pull out each month, and the video that supports that. So if we just scroll down over the Patreon here, you can see the most recent post I pull out is Economic Indicators Monthly Review. This is where I cover housing, permit starts, completions, the Institute of Supply Management Report on Business for Manufacturing. I sometimes look at services, but manufacturing this month, which is the primary one I look at. Consumer surveys from the University of Michigan. Yield curve information, Fed funds rate, unemployment data, CPI data. This is only available to patrons, and I do it every month to get an idea of how the economy is looking going forward, not looking at the stupid or pointless lagging indicators which the media throws at us, but looking at things long before they happen. Okay, and then we've got a couple of live streams. Like I said, I do the live stream each week for our tier 2s and tier 3s. And then we've got our dividend stock picks for December. Soon this will be for January 23, which will be coming out next week. So perfect time to sign up and have a look at the available investment opportunities going into the new year. Alright then guys, thank you very much for joining me on this plug for the Patreon. I ask you to really take some time to consider joining up. It is definitely worth your while, and feel free to follow the link in the description box below. Come over and have a read of the tiers for yourself. And yeah, thank you very much for listening. Now let's get back to the video. Hello everybody, and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, hope you've all had a wonderful Christmas, and it's time to get back to work. We're going to start by covering our top 5 in the S&P 500, which in this case is Apple, Microsoft, Tesla, Amazon and Google. We've done all the legwork for these charts individually. Now it's time to try and bring them together into one YouTube video. Now, first time I've tried to do this, so I have no idea how long it's going to take. I've got a little timer next to me. I don't want to take more than 10 minutes per asset. That would be 50 minutes on its own plus this intro, which I think is a little excessive. So I think what I'm going to do is try and keep it even shorter, and what we're going to do is focus on the things that I find most interesting about each of these charts in a classical analysis sense first, and then we're going to look at a quick update in the Elliott Wave count, and then we're going to try and do that for each of these assets going forward. Now I'm not sure if this is going to be on a weekly or bi-weekly basis in the new year. I'd like to get back to doing at least 2 videos a week for the YouTube, preferably 3 would be the preference, but time constraints are time constraints. Now obviously if you're a patron and you want an individual update for any of these assets or any other asset, you can always just ask me in the weekly live stream and I will update you, or I'll post a chart for you on the Discord. So without further ado, let's get underway. We're going to start here on Tesla, so let's go. I see play button pressed. Right, so we've got 10 minutes or less to try and talk about Tesla. So the first thing I want to do is just get rid of the count. I just want to look at the exponential moving averages on the weekly time frame to begin with here with our 60 and our 250. We've broken the 250 weekly exponential average, and we've come back to this long-term trend, taking this high, this low, this high, and now this low potentially. So this could be 1, 2, 3, 4 on a larger time frame. Basically supports our primary count. If we look at local support levels, we've come back to 111.81. This is the prior highs here and the prior lows here, and we've basically bounced at this point. I say bounced, we haven't yet. We could still continue to fall. What I mean is I'm expecting a bounce to come soon. Resistance above us obviously at these prior levels here, where we can see 211, 260, 315. If we bring up our FRVPs, we can see just how thin the trading really was for Tesla ever since the March 2020 low. We don't really come into any kind of structural significance until we get around into this region here. That's going to be a major support level if we do come down lower, and it is possible we may come down lower. You can see how there's actual gaps here in the volume profile all the way up to the high, very, very thin on the ground. And as you know, it's proven so as we've broken down quite violently. There hasn't really been anything here to catch us. We've got these little demand zones. We've sliced through this one here of this prior trading here. We're now in this one currently, which is a move up and a move back to support, finding buyers and advancing. So we're in some kind of little localized demand zone, as we can see with our FRVP here. We've got this area here, which we can see here on the visual range volume profile as well. So there is some support here as well as structural support, which we've mentioned. Now we also have a couple of gaps on the chart. We've got a gap here. We've got a gap all the way back here. You might say, well, there's not a gap here because it's a solid bar. That's because that's on the weekly time frame. If we come down to the daily time frame, there's a gap here, and there's a little floating candle in between two gaps here on the daily time frame. Now, we haven't come back to fill either of these yet. We don't have to come back and fill gaps. It's just quite common for that kind of behaviour to occur. Correction length is now 421 days long as I speak to you, so it's becoming one of the longer ones. Not as long as this primary correction here, which was 623 days, but it's getting a little long in the tooth. Price correction now is down 73.76%, which is pretty significant decline in price. Okay, so let's come off of log now, come into the smaller time frame, turn off of that, and we're going to come down to the daily time frame. Actually, we're going to stay on the weekly first. We're just going to point out our indicators. So, weekly time frame, we are extremely oversold. We're now down to 22.56 on the weekly time frame. We're still below this downward trend in the OBV. No sign of that break it, and no sign of that reversing yet. In fact, we've actually got an alternative sign of it actually intensifying and breaking the lower support here in the OBV. So, this could be a sign of capitulation, and that we might be approaching some sort of low. If we come down to the daily time frame, we can see that the bearish momentum did increase in this sell-off quite significantly. Just started to cool off over the last day, and we've reached levels on the RSI that we've never reached before at 10.73 for Tesla, which is very, very oversold at the moment. We can see how this long-term trend in the OBV from June 21 broke, and we've now really sold off violently. Now this supports a pattern we can see here on the chart. If we just bring it up, which is our head and shoulders pattern. Now what I've got here is a one-to-one extension. What I find quite interesting here, and one of the things I feel is most significant about this chart, is that we've broken the neckline from our left shoulder, head and right shoulder, and if we take the length of our move down to the bottom of the right shoulder, back up and then project it forward as a one-to-one. Now this is a rough estimate for a broken head and shoulders pattern, that the distance you tend to move before the neckline is the distance you'll move from the top of the right shoulder. Not always the case. Some people will measure it from the lower neckline, but honestly, depending on the scale of the chart you're on, that could easily take you below zero in an exponential asset like this. I just find it interesting that we've got a one-to-one relationship roughly at support. Okay, roughly in this little demand zone. We've got, and we're extremely oversold, so some kind of bounce here from a classical analysis point of view wouldn't surprise me at all. Right, however, in terms of Elliott wave count, I see it going a little lower. That's just my personal interpretation. One other thing I wanted to look at was, if we switch back into log for a moment, we can see that we've also come to the 38.2% retracement. Now, I'm not traditionally a fan of using log retracements. I prefer to use linear retracements, but when the charts are as skewed as the one in Tesla, I think there might be a justification for doing so. Now, there's no arguing that 38.2% is 38.2% of something, 50% is 50% of something, 10% is 10% of something, right? If you come back 90% from 70k, you're down at 7,000, right? 7,000 is 10%. You know, that would be like an example of Bitcoin, but you take my point. A linear retracement is the only real retracement, as it is a percentage, and percentages are not, I guess you could say, they're not logarithmic, are they? But if we apply it to a logarithmic chart, whether or not there's any credence to doing this, I'm still in debate with myself over that. We've got the 38.2 here, we've got support here, we've got demand here, and we're extremely oversold. So some kind of bounce feels likely on the basis of classical analysis. So now let's have a look at our primary count. Our primary count actually supports it going a little lower. Okay, so let me explain what we got here. I feel that this is a diagonal A, B, C, and this has an almost perfect one-to-one relationship. Okay, deep zigzag in terms of a deep B, but still looks like 5 and 5 with 3 in the middle, as opposed to 3, 3 and 5. Okay, we then have a ABC with a pretty strong skew as a zigzag in an X wave here, with the C being very short. You could count this as a double zigzag, but we've got a higher low here, right? So I prefer to see this as a truncation into the C. I know that's not particularly, people aren't particularly fond of that idea, but this does count as 5 down as a diagonal in itself, and it just looks more like an impulsive move than this does, and this breaks down better as 5. So maybe if you wanted to try and get it to complete down here, I don't think it would be too much of a problem. You could put the C to here, ignore this truncation, and then you could go W, X, or you could go A, B, C, W, X and Y. You're still going to have a pretty short Y wave relative to, you know, the W. So I just prefer this as A, B, C with a very short and brief C wave. It's not ideal either way, but that brings us into an X, and then we get a much cleaner zigzag move down. We get 5 A into B, and then we get 1 into 2. I think we're now accelerating in a 3, and I think the price action supports the idea of that being a 3. Very aggressive, likely finding the bottom of the 3 now, meander our way across to a 4, alright, and then flush down in a 5th. It only has to clear the 3, doesn't have to be a really aggressive sell off, and that will bring us down into a C of a larger Y of a larger wave 4, and that will be this correction over, and we would have bottomed probably around 80% sell off, maybe a little bit more. So very aggressive sell off here in Tsla, but yeah, that is essentially how I see things at the moment. W, X, Y, A, B, C into the W, and another A, B, C into the Y here. We're now in that C wave. We've done most of the work. We've got 4 and 5 to go, I think. No really strong evidence of having found the low here in the 3 yet, but we'll see how things develop over the next week or so. Right, that's Tsla, so let's move on. Okay, so next, Aapl. Right then, so on the weekly time frame, let's come out to that first. We've got the 60 exponential moving average being back tested here on the weekly time frame, and then rejected, nowhere near the 250 yet, still a long way above it, unlike in Tsla where we still have a lot of, where we're already below it, I should say. If we look for local support, we're coming into a zone of local support here on a weekly time frame. We've got these previous highs within this structure and these previous lows around 118.62. This is all very messy because I believe this to be 3-4, 3-4 and this to be 3-4. In other words, we're overlapping. Right, we've got a bunch of 3-4s overlapping, just like we had a bunch of 1-2, 1-2s overlapping back here. So I believe this is an extension into a wave 3, and therefore we're getting all of this overlapping noise. Now, if we look at our FRVPs from here, we can see that we're quite top heavy. Right, we've got all of this trading volume going on here. However, we've then got a gap below us, which is just this little blue zone here in the FRVPs. Trading is generally really thin all the way back to the 2019 high before the sell-off into COVID. So, if we are going to find support within a larger wave 4, which I believe this is, we will find it in this area. Okay, I know it's pretty vague, but we'll find it in here and we'll move higher. If we don't find anything in this area at all, then there's very little to stop us from coming all the way back to that 2019 high, falling through this and testing that all the way down around 80 bucks. Okay, which from the high of 183, that's pretty severe collapse in price. Aapl has yet to fall too much. It's down 31% if we look at the correction in price at the moment, 31.2. Time correction is 358 days so far. We've got some monumental corrections in Aapl going. One going back in the 80s, which is around 3,800 days, like 10-year correction, longer. And then we've got one of about 1120 odd, which was a super cycle wave 2 back in the tech bubble. So we're still on the smaller time frame at the moment. Now that doesn't mean this can't morph into something much more scary, but for the meantime we're still overlapping into prior territory. We've got this demand we're coming into on both longer term and shorter term areas here, but we're coming into this major demand zone. We've got local support, and we're oversold on the daily time frame, coming back towards it on the weekly time frame, with some divergence between MACD and current price on both MACD and RSI. Some bullish divergence. Now it's not actual divergence because we don't have a confirmed low here. It's just between a prior close and current price. One other thing I would really like to point out before moving on to the Elliott wave count is my cycle wave pitchfork, which comes off of cycle wave 1 within super cycle wave 3. This is the pivot going back to December 07. So this is the GFC, this is the tech bubble, right? Now everything since the GFC has been contained within this pitchfork, and it has been religiously contained. It's a really nice piece of geometry, this one is. We can see how frequently coming up to the 61.8%, the golden ratio, even out of it in this case, but always we're getting pulled back to a major level. So the median line here, 38.2, median line 61.8, 38.2, 61.8, median line for 23.6, 38.2, 38.2, 38.2, 38.2, median line, median line, median line, median line, median line, 23.6, 61.8. You see what I'm saying? You get the idea, right? If we look at the last few years of price action between these levels, we've gone roughly that 78.6, golden zone 38.2, 61.8, 38.2, 61.8, 38.2, above it again, back to the 38.2, kiss to 61.8 goodbye, the golden zone, down to the median line, back to 38.2, kiss out goodbye, median line, median line, median line, break down to the 23.6 here. So we're back at a support level within the pitchfork. If we bring up a wave 4 retracement in linear, we can see that we're roughly in between the 23.6 and the 38.2. We're also falling back into prior wave 4 structure. So like I said, we either find support here or bad. Essentially, just bad things will happen. Alright, so we're looking for that to confirm the count. On that note, let's bring up our primary count. Right. Long-term count here as well. Come down to the 4 hour. This is what I see happening. Now, unfortunately, none of these assets wanted to paint as a clear 5-wave structure from the high as an impulse to say A. Here's 5, we know 3, and then we're going to get 5, and it's a zigzag, right? Because of that, a lot of them have really convoluted, messy tops. Amazon, Microsoft, Apple, they all tend to. A lot of them are also saying 3s into 4s. This fits better overall with all this overlapping price data and annoying, frustrating tops. We don't get nice, clear zigzags. We get these dodgy structures instead. So I see this as W, X, Y, X and Z, and it is dodgy, there's just no doubt about it. I've tried to look at this as a expanding diagonal, but I can't make it work because the subdivision just isn't there, because everything has to subdivide as zigzags. You know, I've heard people say, oh well, what if it's a leading diagonal, it can divide as impulses. I can't get it to divide as impulses either, so I can just get the smaller structures to subdivide the way I want them to. So the way I see this is an A, B, C, looking at 1 to 1 here between the A and the C, and a triangle in the B here, A, running B, C, D, E, 1, 2, 3. I don't even think it is a running B actually. No, it's not. Basically comes back to where the A began. It could be a running B, doesn't matter. It would be legal either way. A, B, C, D, E, triangle B, 1, 2, looks like 3 down so far, 4 from this oversold condition perhaps, and a flush down in the 5th, bringing us back into this prior support, all this noise here, into these prior wave 4s. Okay, we can finish our larger wave 4, and then we can get moving to new highs. Like I said, if all of that structure breaks down, bad news, because Apple is such a huge component of the SPY. That's bad news for everything and everyone. At the end of the day, that's much more bearish view. We'll have to come back and readjust. Alright, so let's save Apple there. I don't think there's anything else to talk about. On the shorter time frame, how have we done for time on that one? Did I even start the timer? That's not too bad. Alright then, so we'll excuse me, I'm just having a think for a minute, make sure I haven't missed anything. Yeah, we'll take the extra time we save there and move on. Okay, so here we are on Microsoft on the weekly time frame as well. So let me just reset the clock here, so keep an eye on how long I'm taking to do this. Okay, so similar story to Apple, down through the weekly 60 exponential moving average after finding support, breaking it, come back to it, kiss it goodbye, and off we go, heading towards the 250, still above it, not as severe as we've seen in Tesla, more severe than we've seen in Apple. However, current price correction is 38.96 to the low. We have a swing low currently in place with a move to a higher, with a high. We're looking for a higher low and then a further move up, or we're going to break down like everybody else, like Tesla's broken down, Apple's broken down to new levels, Microsoft hasn't yet. Singles it out as being slightly different in the short term, at least behaving slightly differently. Overall behaving similarly. So a significant sell-off, but by no means what we've seen in Tesla, more severe than what we've seen in Apple. Time frame, we need to extend this slightly out. Assuming that's the low, we don't know, but it's a low at the moment. It's 343 days. Okay, and if we look at our support and resistance as well here, and let's also bring our supply and demand. Sorry, let's bring up our indicators first and see what we can see on the weekly time frame. So we got divergence to some degree between these lows here. Okay, and these lows here on the MACD, as we also did on the RSI. These were confirmed lows. We've moved higher since. Still below that downward trend on the OBV. No short-term divergence to speak of, but a bearish divergence on the smaller time frame between these two recent highs, heralding this current correction that's now coming down lower. So we can see that on the smaller time frame. No divergence to speak of between current lows because we're actually trading above the previous low. Like I said, that separates it from the others we've been looking at. So let's come down to the daily time frame. And let's have a look at some structure here and see what we got. Always have a regression channel. I don't think I brought on a regression channel on Tesla or Apple. I neglected to do so. Either way, two standard deviations from a mean in a downward trend. We've pipped it a couple of times. We have again recently. I'm not going to be convinced really by a move that's bullish until we come out of here. Okay, and every move that comes out in 5 is going to be a larger 1. Right, so that would be a 1, come back in 2, and then we can move on higher throughout the year. We're still very much in this downward trend at the moment. It could even be a move to here, corrective move out of it, and a further move lower. That's also possible in a larger bear market if things break down more. Still within that downward trend, corrective pitchfork still containing price as well, with some extremes. If we look for local support and resistance, we will need to add in a new resistance level since coming back to this high here, in amongst all of this noise here. We came back to 215 spot 18. Now if we bring up our FRVPs for a minute, we can see that this is a point of control and a demand zone, basically coming into some thicker trading here, right around this point of control, right around support, and we bounced off of there. Much closer to the 2019 February high than we were in Apple or in Tesla. Believe it or not, that's how much Tesla ran up. That's demand down here. Beyond that, some thin trading until we get back to July 2019 and the COVID lows back here. So there is plenty of room for it to get a lot nastier. Right, a lot nastier, there's room for that. But we're just getting a little overdone, I think, in the short term. So maybe we push for another low like we've seen in Tesla and Apple. Maybe that was the low in Microsoft and we're looking for at least a counter trend move higher into resistance before rolling over again. Or we've bottomed. Okay, so we're not quite in the same peril in terms of there being little below us. We've got a lot more support staggered below us than we have in other places. But we are still undoubtedly in a bearish trend. So let's bring up our primary count here. We've got a bearish one to look at as well. So primary count, it's another 3 into 4. that we're looking at here on the larger time frame. And once again, it's W, X, Y, X, Z. Double zigzag, zigzag and zigzag. Now you might say you can't mix the two. You can. They're part of the zigzag family. There's nothing telling you that you can't have double zigzags within W waves or double zigzags within Z waves or Y waves. They're all zigzags. I don't know where people are getting that from. Please show me in the Elliott Wave Principle where you've read that, because I can't find it. It's not there. We're all classified as zigzags on the same page, whether they're double zigzags, triple zigzags, or whatever. They're all sharp corrections, okay, which can make larger combinations. Now, anyway, getting back to the point, what have we done in the meantime? Well, we've either gone 1, coming back for a 2, we're going to go 3, 4, 5, or we've gone A, B, and off into a C. And that is essentially the short-term count. I'm going to label that minor degree for the moment. So 61.8% retracement in the region of would be normal, which we've come to between the 50 and the 61.8. Doesn't quite look complete as a three-way structure. Maybe it's an impulse and we're going down. Okay, so the bullish invalidation, nice and simple. It's just down here. So put in this invalidation level. Okay, lock those in place and put them inside of the bullish count. Knock it down. Like I said, we just haven't had a nice structure from the high anywhere, have we? Right. When you look at the major swings in here, right, we've got overlapping all over the place. Right. Or we can settle for really poor wave relationships which don't subdivide correctly and then still run into trouble anyway. So I generally see a bunch of zigzags. That's all I can see at the moment. And so it looks corrective, but it could all be part of a larger move. We don't know, do we? If we're in for some kind of multi-year bear market, all of this zigzag noise could just be a free. Just to make a 3, just to make a 5. Right? We don't know. But all we know at the moment is things are looking a little overdone. We've got to move off of the low currently. Not sure if we're supported by volume here. Let's look at the actual low. Right, the push up from the low was supported by volume, and again here, but now we've had a really strong bearish push down here as well. So if we rally somewhere between the 50 and the 78.6, or even the 89, and then bounce in another 5 and a 3, that could be an opportunity to go long. Alternatively, bearish count suggests that this is just another A, B, C, right, into an X, and we've got going to push that Y down deeper. So rather than having a triple zigzag, we make the whole structure a little bigger. So we come down in 5 into an A, B. We can't go 3 and 4 because of the overlap, and we can't go 3 and 4 here because of the overlap, and we don't have 5. But what we can do is go A, B, C, W, X, and then W, X, and Y for the Y. We could try and get 5 in here and say A, B, C. I'd be cool with that as well, right? But it just doesn't subdivide very neatly, because that would be 1, 2, 3, 4, and 5. But we could always label it like that if you wanted to, and we could have zigzag and zigzag and just label this A, B, C instead. That's a more bearish scenario, looking at the price breaking that level. So a invalidation point for this bearish count would be up here. Okay. Alright, and as we can see, still in that downward regression channel at the moment. So this fits quite nicely, this bearish one does. But looking to find some kind of support. Maybe if the bullish count says essentially that we've come into all of this prior noise, right, and we've found support in what we call demand. We've got the FRVPs and point of control to support it. but we've got a lot to prove in order to get out of here. We have to have a higher low and another higher high, and then we're still subject to 3 waves. We need a 4th and a 5th to have any real confidence coming out of here. That gives us a 1, right, or an A. At that point we correct into a 2 or a B, and then we get a 3 or a C to new highs in what will be a flat or a new bull market. There will be opportunities to buy off of deep retracements, is my point. Okay, so now did we added that in. Put this into the bearish count then. Save it. That's the timer gone. So let's move on. Okay, so here we are on Amazon. Now this is not going to take very long, because from an Elliott Wave point of view, I haven't got a foggiest. I literally haven't got the foggiest of what the hell this is. Alright, it's just an absolute pig, putting it simply. I'm still working on it, but a recent count I had broke down, so I need to come back and find the time to do it. But let's start with our classical analysis first anyway. So coming out to the weekly time frame, we can see much more bearish structure here for Amazon than we've seen in even Tesla in terms of long-term exponential moving averages here. We've broken the 250, and you can see how frequently this thing gets tested. I know people like their 100, their 200, 300, people like their 50, whatever. I've been asked multiple times why I use 60 and 250, and I've explained it to my patrons, and they tend to get it once I explain it. But we can see back tested here, back tested here, back tested here, and then we break. Okay, we saw the 60 exponential, back tested here, 2 bodies of the candle, support here, and then break. Now rolling over to what we might call a death cross. Now people always tend to get a little apprehensive and a little shivery when they hear death cross, but the fact of the matter is, throughout the history of most assets, when you get these exponential moving averages of the 60 crossing through the 250 on any time frame, it tends to herald a low. Not necessarily a bottom, right, as in with bottom, but it tends to herald a low being close. Okay, now we don't have to come straight to it, we might just kiss it as it reverses, right, because we're rolling over already in the 250. It's going to take a long time to turn that 250 around, even with a big bullish move from here. So we've just got to keep that in mind, but we could be in for a death cross. We need to keep an eye on the next, a month or two, see what happens here, and then should be getting signs of a low either coming in prior to it or coming in soon after it. Would be normal. I'm not saying it's a guarantee, I'm just saying that would be normal. Okay, because death crosses tend to show people selling. Retail tends to sell off of a death cross, and what is retail selling? Retail selling is institutional liquidity, is buying for institutional, is liquidity for institutional buyers. I'll fucking get there in a minute, excuse me. So retail comes in and piles on the selling pressure. This is the perfect opportunity to go long, right? Because all these people are throwing their cheaper Amazon shares at you. Okay, so that's why these traditionally bearish signals tend to get misinterpreted. Now, sometimes they are just flat out bearish, okay, but they, even when they are bearish, they still tend to herald at least a bounce before coming lower again. But they can, okay, I spent all that time, 2-3 fucking minutes talking about death crosses. Let's move on. Alright then, so support and resistance. Back at a major support level now, 81.91. If we look at demand zones as well, we're thicking all of this demand here. Alright, we can see if we bring up our FRVPs as well, this is a major area of support here around this point of control from this swing low to swing high here. We can see it here on the visual range volume profile. Here is again on the longer term move up from bottom to high. Similar to what we saw in Apple and Tesla, thin trading for a while after that. And then a bunch of demand here, quite intense for such a small pullback, right? And then we've got to come all the way back into 2016 and the 2016, 2017 before we find something. So we're already back in. The point is, with Amazon here, is we're already back in to the March 20 to 20 low, right? That's what the current support. So we've undone all of 2020. We're heading back into all of this support from 2018 high, 19 high. Excuse me, this big sell-off in December 18. we've got to look at as well. So we're in an area where once again we're likely to find some kind of support, at least temporarily. We've got strong divergence on the weekly time frame on the MACD, strong bullish divergence on the RSI. These are not confirmed lows, so they're not officially divergence, but they are strong divergence between previous lows and current price. We've got a general weakening of bearish momentum over the weekly time frame. If we come down to the daily time frame, we can see strong bullish divergence again on the daily time frame between the MACD here and the RSI here. Okay, we've also got short-term bullish divergence between closes on the lows for both MACD and RSI. Bearish momentum seems to be dying off even more. Still accumulating bearish volume on the OBV. Going to take a long time to turn that trend around. Okay, and if we just come off of log for a minute, and if we put in our little pal, the regression channel, still trading downwards within 2 standard deviations of the mean. That is how the things look in a classical analysis point of view. Again, back into some really thick trading, every reason to find support, back into some major structure. Alright, will it hold? We need to see in a longer term time frame an impulsive move through a major level and then a 3-wave move back. That's 1 and 2, or that's A and B. It's the same story in a lot of places. Okay, this kind of damage over this kind of time frame takes time to undo on the other side, just as it takes time to undo all that move up. Right, so patience at the end of the day. What I would encourage people to think about, which is always easier said to do, easier to say than do, like I mentioned, talking about wave personalities, where we are in cycles. If you were willing to pay $187.89, which somebody was for Amazon, okay, are you willing to pay $82.60 for it? Sentiment, isn't it? It's all about sentiment, guys, because the amount of lamenting I hear when markets are going up from not greedy people, just normal people who are like, oh, if only I brought it here, if only I brought it there, and then it comes back to them and they don't fucking buy it. Alright, so that is just what it is, guys. Elliott wave count, I'm just going to have to wave a white flag at the moment. I've got longer term count is legit. If I can find the damn thing. Longer term count looks okay. Alright, I've got long term geometry as well, which looks okay. So take a gander at this primary channel, right? This is based off of 1 2 1 2 1 2 3 4 3 4 and 3 4 way off into the future. Amazon will probably rule the planet by then, all but shy of it. And this is channeling quite nicely at the moment. Maybe it's done. And this is 3 into 4, and this is some kind of screwed up flat pattern, and we go up into 5. When I come into the smaller time frame, getting this correction to make sense is an absolute pig. I've gone back and forth so many times. The problem is we don't have an impulse to here, to this high. We don't have a diagonal to this high. Right, we then get a lower high here on the intraday and on the close. So we can't finish on a 3-wave move where we've had an impulse into here. Okay, we end up with an impossible count into the top. So we can go 3, 3, and then whatever the hell this is. So I've gone back and forth on this. I've gone so far as to say, well, maybe it's a flat, and we've got 3 to here, 3 to here, and then we've gone some kind of expanding diag. Right? So if I were to take that as the 1 and the 2, that as the 4, or 2 into 4, we end up with this diagonal pattern, and then we can go A, B, C to come. Right, with 1, 2, 3, 4, and 5. One's here. Now, what's wrong with this? A lot. A lot is wrong with this. So, first of all, flat targets. We're so far beyond the 1618, it's just silly. Right, so let's go for wave 3 extension. We're beyond the 2618. Do we want to believe in a wave C that goes beyond the 261.8% the extension of the A? Not really. I don't think so. So it just doesn't fit as a flat. Okay, if we try and get the high here, how the hell do we get a top to here as a motive structure? We can't get it to here, let alone over here. Alright. Even if that was 3 and 4, there's no 5 here. That's a 3-wave move, and there's no diagonal here either. So it really has flummoxed me, to be absolutely honest with you. You could use some kind of trashy diagonal, which is what... trashy zigzag structure, which doesn't make any sense. Anyway, that's the timer. So I've actually ended up talking a lot more than I thought I would here on Amazon. I guess it's because it's confusing me. So... don't know what to make of it, guys, from an 8-wave structure at the moment. Like I said, you could say double zigzag, W, X, zigzag here, but then now that's broken down because we didn't get 1 and 2, so Y has to be deeper. Yeah, I don't know, guys. I really am stumped here trying to make sense of this. Too much overlapping price action for it to be an impulse. No way of getting a clear high. So feel free to make suggestions. I've gone back and forth several times. But I can't really suggest anything other than to look at the classical analysis at the moment and go back to that part of the video and look at all the support and resistance I was talking about. So let's call it there on Amazon. Okay, so wrapping things up with Google. Right then, so on a weekly time frame, let's bring that onto the log so we get a clearer look at the chart. We are back at the 250 exponential moving average on the weekly time frame. We have not set a lower low yet, just. It looks like we want to, but we're not quite done it yet. We're in a similar position to Microsoft. Okay, we've got that higher low. Currently, we are still in a downward trend in the regression channel, very neatly, staying within 2 standard deviations and just generally fucking plummeting. Okay, now if we look at the overall price correction, so far we've got a 44.99, 45% sell-off. More severe than Microsoft and Apple, not as severe as Tesla. Okay, but still pretty significant. We are not back at the March 20 lows like we saw in Amazon a little while ago, but we're not as far off of them as we were in Apple either. So we're kind of a mixed bag. We have a clear impulse to the high, thank God, which at least gives us a possibility of considering some kind of sharp correction directly from the high. That seems clearer than in many other circumstances we've seen. So 44% sell-off, or 45 we can round up to, I think. Correction time so far is 350 days. We've got longer ones in the past, we've got shorter ones in the past as well. Okay, now did I have a piece of geometry that I like the look of? Cycle pitchfork broken, primary broken. Let's bring up our FRVPs at the top here. These were gaps on the daily time frame, if I remember, and we have filled both of them, so we've repaired structural damage to the chart at least. Okay, back into some demand. Essentially around here, 2019 high, well sorry I should say February 20 high, excuse me if I've been saying 2019, my mistake. Back into some major demand down here. Temporary demand here is where we're currently at, around the 250 weekly moving average. Filled these gaps, some thin trading to go, and then back into some serious action from that point. Support and resistance, we've got local support between these lows and this high here, 85.17. Price action is looking weak. Volumes dropping with this bearish sell-off on the weekly time frame though, so could be a deep correction. Yeah, essentially a similar story. We're in temporary demand with room to move lower. We're still in a downward trend. If we keep breaking these levels, we're going to come back until we find something much sturdier. Okay, and the most sturdy thing I can see is all of this. Right, now this is all the way back at the highs of 2018, another high of 2019, a low here in 2019, a temporary low here in the collapse of 2020, and resistance here on the way back up in May 2020. Major support there at 64.54. That's still a long way off from 86 bucks, but we could get there. Right now, like I said, in a world where somebody paid $152 for Google, would you pay $64.50 for it? I certainly fucking would. Alright, long term I certainly would. So we may bounce from here, but it's the same story we've been discussing in most places, which is we need something convincing off of the low. Right, this could still be 1 into 2, 3, 4. If we get 5 waves out of here, that's 1. Or A, in a much larger correction, here comes 2, and then we're off in 3, or C. That's what we're kind of looking for. Now obviously, using the STS standard trade setup that I teach on the Patreon, we can shrink that down to much smaller time frames and just play the corrections or play the impulsive moves within them on a smaller time frame. 5 up, 3 back, 5 up, 3 back, 5 up, 3 back, 5 up, all the way down to the minute chart, if that's how you like to roll. Okay, so anyway, that is the classical analysis picture. Let's just have a look at our indicators on the weekly time frame. Bullish, no divergence, sorry, because that's not a lower low. Still below the trend in the OBV. Going to take a lot to break that on the weekly time frame. We've come to oversold. We had divergence between close here on the May low through to the October low. We had divergence on the RSI. It hasn't really amounted to much yet, to be honest, and if we roll over again, we're going to get a deeper oversold condition if we continue down in this regression channel and go lower anyway. So we need to see a bounce which is more convincing than what we've seen so far. Come down to the daily time frame, back into oversold conditions. No, sorry, there isn't, because that's a higher low, excuse me. Still well below that resistance in the OBV. Bearish momentum is pretty strong overall at the moment. No reason to think this won't continue to go lower. At the moment, I think it's likely that we'll continue to push lower. If we do bounce from here, then the bullish count will be 1 into 2, won't it? And that's a pretty good buying opportunity where it is. So let's talk about that then. Let's bring up the count. So it is primary count into the high. We actually get 5 waves into a high, which is nice. Let's just turn off the exponential moving averages for a moment. Let's have a look at this correction. Very rough idea. I'm still fleshing this one out at the moment. Okay, so this breaks down as 2 zigzags much more neatly than we've seen with previous charts. There's one zigzag, there's another zigzag, and here's a wibbly wobbly bit in the middle, right? A connector, as I've heard some people elegantly call it. It could just be a zigzag. 5, 3, 5. Right, could be 3, 3, 5 as well, some kind of flat, but I think 5, 3, 5 fits in there perfectly well. Okay, now one other thing I've seen people do is go 1, 2, 3, 4 and 5. I'm not completely opposed to it. Not completely. It doesn't work anywhere else because of the overlaps, but it kind of works here in Google. But the problem is this looks like 3 to me. Really, really does look like 3, and this looks like 3 to me. We still want this to be 5, right? And that to be 5, 3, 5, 3, 5. This breaks down as 3 in my eyes, and therefore it looks more like a zigzag. So I prefer to look at it as a double zigzag. Bullishly, it's 1, A, B, C, 2's in, and we're off, and it's party time. Right? If Google breaks this regression channel and we go bum, 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 and we get a 1.618 extension at least off of that pivot, we're talking a potential 3. Then into 4, then into 5. If we get 5 waves complete out of here, that's 1. So going about trading on a shorter time frame, let's have a look at the kind of risk you've got here at the moment. So let's come down to the 2 hour and see if we can at least convince ourselves of something. Now you could say A, B, C, this is corrective, this is not bullish, and this is 1 and 2 and 3 and 4, and down we come in 5. Fine, it might well be that. It might well be that. But you could also potentially convince yourself that this is 1, 2, 3, 4 and 5. It's not the prettiest of impulses, and therefore you could convince yourself that this is A, B and C. Right, now at that point that's 1 into 2. So based on that, we've got A somewhere between 78.6 and 89% retracement. So we are tightening up, significantly tightening up margin of risk. Now it's becoming a lot less likely to be bullish with such a deep correction. Well, a lot less likely is probably unfair, but from yesterday's close, we've got 300 basis points, 309 basis points to the low of risk. Now, if you want to shrink, you could just take that off of there and say, right, here's your stop. You come up in 5, you come back in 3. Okay, you could even argue that this is 5, right? 1, 2, 3, 4, 5, and this is A, this is B, and this is C. Right, and you've gone 1 here into 2, and this has a better looking relationship, and this is just a very, very big flat. I prefer this to be a zigzag because it would just be a little too big as a C wave for a flat, but either way, alternative way of looking at it. So smaller for wave 5 up, breaking trend, coming back to a higher low, with all the signs in our indicators that we want to see when we're applying the SCS in terms of shifting momentum, divergence on smaller time frames, flipping our exponential moving averages on a smaller time frame, getting an impulsive move and another pullback. We know what we're talking about. We're talking about the standard trade setup. We can potentially shrink that margin down even smaller. I'm not sure how much smaller, maybe less than 2%, maybe 2%. But honestly, do you need to apply the SDS in this circumstance? The only reason you'd be doing it would be to look for directionality to a higher high and a higher low, to give you a sense that you've broken that downward trend. But when you get this close to a prior low, you've got like 3% risk here. Okay, you could go long from here with a structural stop in place, and you're not taking too much risk. Okay, I'm not telling you to do that. I'm just saying you could. We would normally look for directionality in the previous trend for our reaction to show up, 5 up and 3 back on a smaller time frame, see how things look from a momentum point of view, see how things look from our indicators point of view, and then make a call off of that. Shrink it down a little bit is what I'm saying. And then you could be 1, 2, 1, 2, and you could be off to the moon, right? Well, not off to the moon, but you could be off to the new highs with minimal risk. Alternatively, it's bearish, right? And it's going 1, 2, 3, 4, 5. In which case, here's your invalidation point for the bullish count anyway. Okay. And we'll just put the 83.36 down there. Alright. So that's how I see things in Google. It is bullish for the moment. I know it's deep. But if it's not, I'll have to just extend this lower. Okay, I'll have to rethink about what this is. I'm not quite sure how I would explain this move here yet. It could even be another connector. It could be 3, 3 and 5 as a flat, right? It could be another 3-wave move of a larger swing before coming down again. That's also possible. Alright then guys, I think that covers everything, doesn't it? We've done them all. Let me just have a quick check. Google done, Amazon done, Tesla done, Apple done, Microsoft done. Okay, so there you go. That's our first video covering all 5 assets in one video. I think it's a little long-winded, and I don't think I've got all the detail in. Like I said, first time trying to do it, so give me a break if I haven't spoken about everything you wanted me to speak about. But I've covered all 5 of them. I'll timestamp it. Let me know in the comments below what you think. Whether this should be broken down into maybe covering each of these a week. So we could say do Google 1 week, Tesla another week, and just cycle them around like that. That might be better. That might be better than trying to ram them all into 5. I would definitely find that easier, I think. So, but give us a feedback and let us know what you think about this format anyway. And if you're new to the channel and like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as always, a huge thank you to my Patreon supporters. Your support is massively appreciated. If you're interested in becoming a patron, head over to the Patreon page by following the link in the description box of the video of this video or any on YouTube, and have a read of the tiers and feel free to sign up. Alright guys, take care of yourselves and I'll be back with you as soon as I can. All the best for the new year. Bye bye.